In this week's update, the likely path to Christmas, and it doesn't get much better than this. Where to find the best value, how to manage your portfolio in volatile markets. My name's Garry Davis, and as always, this is general advice only, and please remember to subscribe and like the video. All right, let's start with some market perspective. The sector rotation hasn't gone away. It's still out there. We're seeing some terrific strength in the American market, and the question was, to what degree would it swamp out and draw money away from the sectors that have done so well this year? And the answer is that the best growth stocks have rapidly regained their composure. Yes, we've seen some dips in the last few weeks, but it seems that the money seems to be staying in the stocks that have done well all year, and yet we're seeing a lot of rebounds and sustainable rebounds in the stocks that were out of favour. So one can only conclude that probably part of the reason for that is that there is money coming out of the bond market, and that's helping to push some of those other sectors up. So it's all pretty good news at the moment. Look, there's a small percentage of these return to normality stocks that will probably do fairly well. I wouldn't include airlines and a number of travel stocks in that, and quite a few other sectors. But there are and there will be some pretty good outcomes, but you've got to be very, very selective. Many will not. So I wouldn't jump on the bandwagon that the media is now pushing, that value stocks are back and that's where you need to go. You need to get out of the expensive tech stocks because they're just an accident waiting to happen, and you need to pile back into the stocks that were disadvantaged by COVID. That, I believe, is dangerous and quite misleading. So the key is to be incredibly selective about what you go into. There are still some outstanding technology stocks, and there are some good value stocks that are rebounding. So there are bargains to be found pretty much everywhere. So it's not at all about what the media is hyping. So just be very careful about what you read. Now, one of the major sectors, so there's 11 sectors in the US. The industrial sector was obviously mostly a stock that was lagging during the last 6-8 months, but certainly industrials are shaping up now as a pretty good hunting ground to look for some of those opportunities. So if we look at the productive industrials, and these are just a few of them, some of the stronger ones, delivery services are just going great guns. They're doing really well. Trucking is going really well. Volumes are up. So, the economic data in America is being confirmed by what we're seeing on the ground. Durable goods orders are going up. Housing market is going very strongly, and that's feeding into durable goods orders. And even some parts of retail are doing well. Footwear is doing really well, not only in the business sense, but also the prices of some of the footwear stocks in America are doing incredibly well. They're in very strong uptrends. And automobiles are obviously doing very well, particularly electric vehicles. Obviously, Tesla is one point in question, but there's also a Chinese electric vehicle stock called NIO that's up many hundreds of percent in just in the last quarter. So automobiles going along very nicely. But also, don't switch out of tech. Don't forget about tech. Semiconductors are doing really well, and it's been a consistent winner this year, and all the signs are that will continue to be the case. Software has had a bit of weakness in the last month or two, but software I think will still be pretty good. And we're also seeing a lot of strength in small caps as well, both tech small caps, but also value or let's call them defensive kind of small caps as well are doing quite well. And the Russell 2000 has broken out. And of course, many parts of healthcare, particularly things like telehealth, anything that's got a technology flavour to it, is poised to continue to do really, really well. All right, let's look at the American stocks. The S&P was down 0.8% for the week. Dipped a little bit at the end last night, but it's been pretty strong. And the economic data was a bit mixed through the week. and that caused a bit of volatility. But look, it's really nothing to be concerned about. The most important aspect is that the earnings season has been really positive. It's been a really high level of earnings beats, and even more so, the forward guidance is coming through really well. Now, US corporate CEOs don't need to go out on a limb to paint a rosy picture for the future. They just don't, and if they don't meet it, they're in trouble. But they're doing it, so that reflects how confident they are about where things are heading. So this is all very positive. And we've got virtually every sector breaking out. We've got transports breaking out. We've got the Russell 2000 breaking out. We've got all of the technology sectors still going along quite well, but now we've got the defensive sectors, the so-called value stocks, are breaking out relative to the aggressive stocks or the growth stocks. And now we're also seeing the industrials are now outperforming the S&P. So we've got virtually every sector breaking out in the States. So, it's very, very difficult not to be bullish at the moment. The US dollar rose slightly to 92.4 and the yield slipped back a little bit to 0.82. All right, let's look at, first of all, we'll start with just checking on the VIX because, this has been such a good leading indicator. And, this was the point up here where I sort of cautioned when the VIX got above 40, cautioned that we were probably at a near-term low, and in fact, the US market turned around the following day. Now we've dropped back to the low 20s and we're holding there. So things are still, pretty good from the VIX point of view. All right, let's look at some of the spread charts that we've been looking at. So this is the Russell 1000 growth stocks divided by the Russell 1000 value stocks. So when the line is rising, growth stocks or the more aggressive sectors that have been doing well all year are outperforming the value stocks or the more conservative defensive stocks or sectors. So you can see we had an immensely strong run where growth outperformed value, but now we're in a sideways period, and I think this is probably going to continue through to Christmas. So I think what we're going to see now is probably a balance. I don't think we're going to see some sort of massive rotation that's going to dent the fortunes of the aggressive sectors. I think they'll probably still do okay, probably not as robust as they have been for the last 6 months, but they'll probably still do okay. And some stocks are just moving up. They're skyrocketing up, some of the technology stocks, even in the last week or two. So there's still really great performance in that sector. But what we are seeing, of course, in the value stocks, in the defensive sectors, that we're seeing some outperformance there. So that's growth versus value. This is consumer discretionary versus consumer staples. So you can see the market got a bit of a fright and some money rotated out of consumer discretionary, went into staples, but as you can see, it's balancing out now. And I think we're probably going to see this line just continue sideways for the rest of the year. And here's the industrial sector. Now this covers many, many different types of businesses. This really is a very, very broad brush. But look at the industrials versus the S&P. So they've been underperforming since February. The S&P had been doing better because it had been held up by the technology sector. But look at industrials since since May. They turned around, and industrials have been outperforming the S&P, and the industrials are now pretty much line ball with technology as well. So it's all very, very positive. And if we look at the S&P, you can see we're just a few points off the all-time highs that were formed just the Monday before last. So it's a very, very positive scene out there in America. And of course, that sets the tone for everywhere else. There's the US dollar. We're just holding support here at the moment around 92. If that were to break, then we're looking at a move probably down to 89. and then below, which would be significant, and then after that you really got to go down to about 84. So the US dollar is looking pretty shaky at the moment. The Australian dollar, of course, is really showing the opposite direction, and you'd have to say that if the US dollar breaks down, then of course our dollar is going to move higher and possibly head towards 80 cents. However, if you've got money in America, don't be perturbed by that, because I'm certain if you're in the right sort of stocks that are really moving, you've focused on relative strength, then you're going to make a lot more money out of those stocks than you're going to lose on the currency. All right, that's America. Aussie stocks. The Aussie dollar was a little bit higher, as we saw, and iron ore was up around $126 a tonne. So that's certainly contributing, but oil was also much stronger. Our index was up by another 2.3, but look, this is largely about the banks, and the banks are not really being supported by local institutions to any great extent that I can see. My understanding is that the strength in the banks has largely come from overseas fund manager buying, which has been a bit more of a currency play than a play on the banks. So I wouldn't be getting too excited about what's going on in the banks. I don't think it's got a great deal more in terms of legs. Small and mid cap stocks is where the action is. We're seeing some rising volatility there, but boy, there's some strong trends and there's some tremendous outcomes. So for me, this is still absolutely the place that you want to be in the Australian market. So we'll just take a quick look at the ASX 200. So we've broken out of this long consolidation that had been in play since early June. And if we look at the banking sector, so that's really what's dragged the Australian market up. Now, turning to precious metals. So this is gold on a weekly. So we were down again a bit, but if you look at gold on a daily chart, we're now almost back to the 200. Other than the sudden plunge that we got on the Monday the week before last, when the vaccine from Pfizer was announced, we're still holding this support here and just above the 200-day moving average. So, this is what I wanted to see. So from here, I think the odds are the gold price probably goes up. This is silver, a little bit better. You can see it's holding a bit further above the 200-day moving average than gold is, so certainly some strength there in silver. And if we look at GDX has been getting held back a bit because of the performance or lack of performance at the fundamental level from the two biggest gold stocks in the world, Barrick and Newmont. All right, so that's the gold sector. So just recapping, down $19 to $18.71, and precious metals, we're down to the 200-day moving average on that sector as well. Turning to other commodities, copper was up to $3.26, so looking very strong. And this is global economic strength and weaker US dollar. So despite the fact that COVID case numbers are just off the planet, the economic numbers are not too bad, and certainly the market doesn't seem to be terribly concerned about it. Crude sharply higher in expectation that demand will go up I think this is a bit more of a vaccine play as well, and as I covered next week, I think this reaction to the vaccines, which is, whilst it's great news, to me is terribly premature. There's just such a long way to go yet to get enough vaccine out there to actually make a difference so that the world can, open up again. So the crude oil sector and oil stocks is still a sector I would leave alone. Spot copper, you can see there we moved up quite sharply in the last week, and it's been trending higher since late September. So wrapping it up, the likely pathway to Christmas for me is that we're going to see growth and value in some sort of rough balance. I don't think we're going to see a massive further shift in money flows. If you focus on the best stocks in each sector, they're not, I don't think you can go too far wrong. The upside of some of these stocks over the next 1 to 2 years really is quite exciting. And the good news about all this is there are literally hundreds of them. It really is an absolute smorgasbord of tremendous opportunities. So if you're an investor that's out there, worried about what's happening and, really digesting the news around COVID, then can I suggest that you stop doing that, because there's just such an amazing game that's going on at the moment, and, you need to get into it, because it just, as I said at the start, I just don't think it gets any better than this. Portfolio analyst coming up this week, I'll just be focusing on the best and the strongest recovery stocks. We've got quite a lot of the really good tech stocks covered, but I'm going to be striving to identify some of the best recovery stocks in the industrial sector. So that's it for this week. There's my website, which contains more information about the services, and there's my email address for anyone that requires that. So that's it for this week. I'll be back with you next Sunday. Cheers.